Dividend Power. Build Wealth for Life. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. Imagine waking up every morning knowing that, even while you sleep, your wealth is quietly growing, compounding, and providing for your life, all without you having to lift a finger. Imagine a future where your income isn't tied to endless work hours or unpredictable market swings. Instead, it's steady, resilient, and powerful. That's the promise of dividend investing, and it's closer than you might think. Now, consider this: 90% of millionaires have built their wealth not through high-stakes trading or risky startups, but through the patient, steady accumulation of dividends. They've unlocked a secret most people overlook, a system that not only grows their wealth but pays them as it grows. What if you too could tap into that same power? What if financial freedom wasn't a distant dream but a tangible reality you could create for yourself? In Dividend Power, Build Wealth for Life, you'll discover how to build an income stream that works for you, creating lasting security and independence. This book isn't about empty promises or get-rich-quick schemes. It's a blueprint for real wealth, wealth that grows and protects itself, creating freedom for you and generations to come. With this knowledge, you'll understand how to make every dollar work smarter, multiplying itself to build a future of freedom, stability, and peace of mind. If you're listening to this now, chances are you're ready to break free from financial stress, from uncertainty, and from a lifestyle where income depends entirely on the hours you work. You're ready for the reassurance that comes from knowing you have a reliable, growing income, a foundation that supports your dreams and grants you the time and resources to live life on your terms. You might be thinking, is this really possible for me? Absolutely. This journey doesn't require complex strategies, high-risk investments, or a large starting sum. Dividend investing is a method that's proven and accessible, designed for anyone willing to take a few simple steps toward financial independence. This book will guide you, step by step, through everything you need to know, giving you the tools to build wealth confidently and powerfully. So, if you're ready to create lasting wealth, to achieve true financial freedom, and to live life on your own terms, then this book is the path forward. It's time to build a future that pays, one dividend at a time. As Benjamin Franklin once said, an investment in knowledge pays the best interest. Let's begin this journey to financial independence together. Chapter 1. The Power of Dividend Investing. A Path to Financial Freedom. Imagine a stream of income that flows into your bank account regularly, without you having to actively work for it. Now imagine this stream growing wider and stronger over time, allowing you to feel secure and even excited about your financial future. This is the promise of dividend investing, a reliable and transformative path to financial freedom. Dividend investing focuses on choosing stocks that pay consistent, stable dividends. Unlike other forms of investing that might fluctuate wildly or require you to time the market perfectly, dividend investing is built on the idea of patience, stability, and steady growth. By reinvesting dividends over time, you can experience a snowball effect that builds your wealth without the roller coaster ride of constant buying and selling. Many people find themselves drawn to investing but feel overwhelmed by the complexity and risk. The stock market's highs and lows can be intimidating, and the fear of loss can lead to hesitation or impulsive decisions. Dividend investing, however, offers a unique way to engage with the market confidently. Here, the primary focus is on building wealth slowly and surely rather than seeking quick gains. It's about peace of mind and the freedom that comes with financial stability. To fully appreciate the power of dividends, let's take a real-life example. Meet Sarah, a teacher who wanted a more secure future. She was tired of living paycheck to paycheck, relying only on her salary for financial security. While Sarah wasn't particularly wealthy, she understood that the key to financial freedom lay not in her earnings but in her investments. She began by putting a small portion of her savings into dividend stocks, choosing companies with a history of stable, consistent payouts. At first, Sarah's dividends were modest, amounting to only a small percentage of her income, but she stuck with it, reinvesting those dividends back into her portfolio. Over the years, Sarah's dividends grew, multiplying in value as she diversified her portfolio with more high-quality dividend stocks. Today, Sarah enjoys a steady passive income that supplements her salary, giving her both financial security and peace of mind. Her story isn't one of overnight wealth, it's a testament to patience, discipline, and the extraordinary power of compound growth. This approach to investing is not about get-rich-quick schemes. Instead, it's a gradual, reliable way to build wealth. Dividend stocks offer you the opportunity to own a share of profitable companies, essentially earning a salary from your investments. When companies pay dividends, they're sharing their profits with shareholders, rewarding you simply for owning a stake in their success. By choosing companies with a record of stable dividend payments, you gain the dual benefit of asset appreciation and income. Dividend investing is especially attractive because it offers a hedge against economic uncertainty. Even in market downturns, companies that prioritize regular dividend payments tend to retain investors and maintain their value. For you, this means you're not just relying on the stock price to build wealth, you're also getting paid along the way. This income stream can provide a cushion in tough times and create a sense of stability that few other investments offer. One of the most powerful aspects of dividend investing is the concept of reinvestment. When you reinvest your dividends, you're essentially buying more shares of the same stock without having to contribute new money. This compounding effect amplifies your returns over time, creating a cycle where dividends buy more shares, which in turn earn more dividends. Over the years, this compounding can lead to exponential growth, creating an accelerating path to wealth. Dividend investing is for those who are looking to the future and are willing to invest for the long term. It's for people who want to wake up one day and realize they no longer have to rely solely on their paycheck. It's for those who want the confidence that their investments will provide steady income, creating a buffer against life's financial challenges. In the coming chapters, you'll learn everything you need to know to start your own dividend investing journey. We'll explore what dividends are, how to choose dividend stocks, and the strategies that successful dividend investors use to build a portfolio that not only grows but pays. Through these principles, you'll gain the knowledge, skills, and confidence to make dividend investing a cornerstone of your financial future. Chapter 2. Understanding the foundation. What are dividends? Dividend investing is a powerful tool for financial growth, but to fully benefit from it, you need to understand what dividends are and why they're important. In this chapter, we'll dive into the basics, making sure you're armed with the knowledge to make informed, confident decisions. A dividend is essentially a reward paid to shareholders from a company's earnings. When you invest in a dividend-paying stock, you're not just hoping that the stock price will go up, you're also receiving a regular payment as long as the company continues to perform well. This payment can be monthly, quarterly, or annually, and it's usually expressed as a percentage called the dividend yield. In essence, dividends are a way for companies to share their profits with you, the shareholder. For many, dividends might sound like a bonus, but they're far more than that. In fact, dividends can form a significant part of your income strategy, especially as they grow over time. Imagine this. You purchase shares in a solid, dividend-paying company with a dividend yield of 4%. This means that for every $100 you invest, you earn $4 per year, regardless of whether the stock price rises or falls. Now, this might not sound like much initially, but compounded over time, and combined with regular contributions, these dividends can generate substantial returns. Let's break down some key terms to solidify your understanding. 1. Dividend yield. This is the ratio of a company's annual dividend payment to its share price. For example, if a company's stock costs $50 and it pays an annual dividend of $2 per share, the dividend yield would be 4% to $50. This yield helps investors quickly compare the dividend income potential of different stocks. 2. Payout ratio. This ratio shows what portion of a company's earnings are paid out as dividends. A high payout ratio might indicate that a company is prioritizing returning profits to shareholders, while a lower ratio could suggest they're reinvesting earnings into growth. For dividend investors, finding the right balance in payout ratio can signal a stable investment. 3. Dividend growth rate. This is the rate at which a company's dividends increase over time. Some companies are known as dividend aristocrats because they have a long track record of consistently raising their dividends, sometimes even through economic downturns. These companies can be particularly valuable for investors focused on income growth. Understanding these terms is essential because they help you evaluate the quality of a dividend-paying stock. Choosing the right stocks for a dividend portfolio involves looking at more than just the yield. While a high yield might seem appealing, it's important to ask whether the yield is sustainable. high yields can sometimes indicate that a company is struggling financially, as they might be trying to attract investors with a large payout. Conversely, a moderate yield from a strong, established company can often be a safer, more sustainable choice for long-term investors. Consider the example of companies like Johnson & Johnson or Coca-Cola, which are known for consistent dividend payments and steady growth. They don't necessarily have the highest yields, but they're considered reliable because they have solid financial foundations and a history of prioritizing shareholders. For beginners, these types of companies are often a good place to start, as they offer both stability and gradual growth. Dividend stocks can fit into a larger financial strategy by providing regular income and capital growth. Many dividend investors choose to reinvest their dividends, buying more shares with the payments they receive. This strategy, known as dividend reinvestment, can exponentially grow your portfolio through the power of compounding. In this way, your dividends start to earn their own dividends, creating a virtuous cycle of wealth accumulation. Dividend investing doesn't require you to be an expert stock picker. By understanding these basic concepts, dividend yield, payout ratio, and growth rate, you're already equipped to start building a stable, income-generating portfolio. While dividends might seem straightforward, they represent a shift from a speculative investment approach to one rooted in the pursuit of steady, consistent returns. This reliability is what makes dividend investing particularly attractive, especially in uncertain economic climates. As we move forward, you'll learn about selecting the right types of dividend stocks to create a resilient portfolio that can weather market fluctuations. This is where the knowledge you've gained about dividends becomes a powerful tool for building financial security. With a solid foundation in place, you're now ready to explore the strategic aspects of dividend investing, knowing that each investment you make is a step toward creating lasting wealth. Chapter 3. The strategy behind dividend stocks. Choosing reliable income sources. In dividend investing, strategy is everything. While it's tempting to choose stocks with high yields, successful dividend investing is about selecting companies that can provide consistent, sustainable payouts over the long term. This chapter focuses on how to strategically choose dividend stocks that will serve as the reliable foundation of a strong, income-generating portfolio. When building a dividend portfolio, there are several critical factors to consider. First and foremost is the company's stability. Not all companies can consistently pay dividends, especially during economic downturns. Look for companies with a proven history of paying, and ideally increasing, their dividends over time. These companies, known as dividend aristocrats or dividend kings, have demonstrated resilience and financial strength, even through challenging economic periods. Think of businesses like Procter & Gamble or McDonald's. They're not the flashiest, but their stability and commitment to returning value to shareholders make them valuable assets. Another key factor in choosing reliable dividend stocks is understanding the business model. Companies with steady, predictable cash flows, like those in utilities, consumer staples, or healthcare sectors, tend to be better suited for dividend investing. These companies often have essential products or services that people rely on regardless of economic conditions. For instance, people continue to need household essentials, healthcare, and electricity, making these sectors more resilient in market downturns. Companies in tech or speculative sectors might offer higher potential for capital growth, but they're less reliable for steady dividend income. For a dividend investor, stability is king. One of the best ways to assess a company's ability to pay dividends is by looking at its payout ratio. This ratio, covered briefly in the previous chapter, is crucial in determining whether a dividend yield is sustainable. A payout ratio shows what percentage of a company's earnings are paid out as dividends. A high payout ratio could mean that the company is using most of its profits to pay dividends, which might be risky if profits decline. Generally, a payout ratio below 60% indicates a good balance. The company pays out dividends, but still has enough funds to reinvest in growth or weather financial challenges. Another important metric is the debt-to-equity ratio. Companies with lower debt levels are often in a better position to continue paying dividends during economic downturns. Debt requires regular payments, and high levels of it can jeopardize a company's ability to maintain dividends in tough times. Thus, looking at a company's balance sheet to gauge debt levels can help you assess how likely it is to continue paying dividends. Building a resilient portfolio also means not putting all your eggs in one basket. Diversifying across different sectors can protect your income stream from industry-specific risks. For instance, if you only invest in energy companies and oil prices plummet, your dividends might be at risk. A well-diversified portfolio might include dividend-paying stocks from sectors like healthcare, utilities, consumer goods, and telecommunications, ensuring that a downturn in one sector doesn't significantly impact your overall income. An excellent way to understand the power of diversification is through the example of Alex, a long-time dividend investor. Alex initially focused all his investments in the energy sector, attracted by the high yields of oil and gas companies. For a few years, his portfolio performed well, but when the energy market took a hit, Alex saw his dividend income decrease dramatically. Realizing the importance of sector diversification, Alex began adding stocks from utilities, healthcare, and consumer staples, stabilizing his income stream and protecting his portfolio from sector-specific downturns. Alex's experience highlights why diversification isn't just about reducing risk, it's about ensuring steady income, regardless of market conditions. When selecting dividend stocks, it's also essential to consider your financial goals. Some investors prioritize growth, choosing companies that might have a lower dividend yield but a higher rate of dividend growth. Others focus on income, preferring stocks with higher yields, even if the growth potential is more limited. Younger investors might prioritize growth to build wealth over time, while those closer to retirement might lean toward income to maximize their dividend payouts in the near term. For example, a younger investor might select a stock like Microsoft, known for consistent dividend growth, even if the yield is lower. This approach allows the investor to benefit from compounding over the years. Meanwhile, a retiree might prefer a stock like a T&T, which typically has a higher yield, providing a more immediate source of income. Understanding your own financial goals helps tailor your stock choices to your unique needs, ensuring that dividend investing aligns with your lifestyle and future plans. As we delve deeper into this journey, remember that choosing dividend stocks isn't about chasing high yields. It's about building a portfolio with stable, dependable companies that fit your financial goals, sector diversifying to reduce risk, and aiming for a balance between income and growth potential. This thoughtful approach is what turns a simple collection of stocks into a reliable income source, forming the bedrock of a solid financial foundation. Chapter 4. Building your portfolio. Diversification and balance. As you embark on building a dividend portfolio, one concept stands out as essential: diversification. A well-diversified portfolio is like a safety net, providing stability and protecting against market fluctuations. The goal is to create a balanced portfolio that generates consistent income without relying too heavily on a single sector or stock. This chapter explores the principles of diversification and balance, guiding you to build a resilient, income-generating portfolio that can withstand the ups and downs of the market. Think of diversification as building a team. If you were to assemble a sports team, you wouldn't want everyone to play the same position. Each player would bring a unique skill, covering different aspects of the game. In the same way, a diversified dividend portfolio includes stocks from various sectors, each contributing to the portfolio's stability and income in unique ways. When investing in dividend stocks, it's important to spread your investments across sectors like healthcare, utilities, consumer staples, and telecommunications. These sectors tend to perform differently under varying economic conditions, allowing you to maintain a steady income even if one sector faces challenges. For example, utilities and consumer staples are often more stable during recessions, as people continue to need essential services and goods. Meanwhile, sectors like technology or financials might offer higher growth potential, but can be more sensitive to economic shifts. A balanced portfolio captures the best of both worlds, providing income stability and growth potential. Consider Lisa, a dividend investor who started with a single sector, technology. At first, her portfolio thrived, as tech companies were performing well and increasing dividends. But when the tech market hit a downturn, Lisa saw her income drop, and her portfolio value took a hit. Learning from this experience, she diversified her portfolio by adding healthcare and consumer staple stocks. This diversification not only provided more consistent dividend income, but also helped protect her from market volatility, making her portfolio more resilient in the long term. Another key aspect of portfolio balance is understanding your risk tolerance. Some sectors, like utilities and healthcare, are considered defensive because they are less volatile and tend to perform steadily even in economic downturns. Others, like energy or real estate, might offer higher dividend yields but carry more risk. Balancing high yield, high risk stocks with stable, lower yield options helps create a portfolio that suits your financial goals and comfort level. This balance ensures you're not relying solely on high risk stocks for income, safeguarding against the possibility of sudden losses. To achieve diversification, it's helpful to set allocation goals. For instance, you might decide to allocate 25% of your portfolio to defensive sectors like healthcare and consumer staples, 30% to growth-oriented sectors like technology and finance, and the remainder to high-yield sectors like utilities and telecommunications. Your specific allocation will depend on your financial goals, risk tolerance, and time horizon. Young investors with longer time horizons might allocate more to growth sectors, while those closer to retirement might prefer more defensive, income-focused stocks. Another way to diversify is by including both domestic and international stocks. Many dividend investors focus solely on U.S. companies, but international dividend stocks can offer additional diversification and growth opportunities. Some regions, like Europe, have a strong tradition of dividend payments, with companies often paying higher yields than their U.S. counterparts. By adding a mix of domestic and international dividend stocks, you can benefit from income across different economies, reducing reliance on the economic performance of any one country. Once your portfolio is established, rebalancing becomes an essential practice. Over time, some stocks might grow faster than others, causing your original allocation to shift. For example, if your technology stocks experience rapid growth, they might come to represent a larger portion of your portfolio than you initially intended. Rebalancing periodically, once a year, allows you to realign your portfolio with your target allocations, maintaining your desired level of risk and diversification. Rebalancing also involves reviewing the performance and sustainability of your dividend stocks. Not every company will continue to perform well or maintain dividend payouts indefinitely. If a company's financial health declines or it cuts its dividend, consider replacing it with a more stable option. This ongoing adjustment ensures that your portfolio remains aligned with your income goals and risk tolerance. For investors who prefer a hands-off approach, dividend-focused exchange-traded funds (ETFs) offer an easy way to achieve diversification and balance. These funds pool together dozens, sometimes hundreds, of dividend-paying stocks, offering instant diversification across sectors and regions. Dividend ETFs can be a convenient solution for new investors or those who prefer not to manage individual stocks. Many ETFs focus on dividend growth or high yield, allowing you to choose funds that align with your specific goals. Whether you're selecting individual stocks or using dividend ETFs, the core principles remain the same: diversify across sectors, balance growth with stability, and monitor your investments regularly. With a well-structured portfolio, you're setting yourself up for a reliable, resilient income stream that can weather economic changes. In the next chapter, we'll explore one of the most powerful aspects of dividend investing: reinvestment. By reinvesting your dividends, you'll discover how to accelerate your wealth-building journey through the magic of compounding. Chapter 5: Reinvesting Dividends. The Power of Compounding. In the world of dividend investing, one concept reigns supreme for building long-term wealth: compounding. Compounding allows your money to grow exponentially over time, with dividends serving as the fuel that accelerates this growth. By reinvesting your dividends back into your portfolio, you essentially buy more shares, which in turn generate more dividends. This self-perpetuating cycle can lead to significant wealth accumulation over the years, transforming even modest initial investments into substantial financial resources. Imagine a snowball rolling down a hill. It starts small, but as it rolls, it gathers more snow, growing larger and faster as it picks up momentum. Dividend reinvestment works the same way. Each time you reinvest a dividend, you're adding to your investment snowball, allowing it to grow in size and power over time. This chapter explores how reinvesting dividends amplifies wealth through compounding and provides practical steps to get started. Compounding is essentially the process of earning returns on your previous returns. When you invest in dividend-paying stocks, those dividends can be reinvested to purchase more shares, increasing your ownership in the company. As your share count grows, each future dividend payment becomes larger, enabling you to buy even more shares. This cycle continues, creating a chain reaction of growth that doesn't require you to contribute additional capital, just time and patience. To illustrate this, let's look at the story of James, a factory worker who started investing in dividend stocks in his 20s. James didn't have a large income, but he was committed to investing a small amount consistently each month. Instead of spending his dividends, he reinvested them back into his portfolio, buying more shares each quarter. By his early 50s, James's portfolio had grown to a substantial amount, not just from the amount he initially invested, but from the compounded growth of reinvested dividends. Today, James's dividend income alone covers many of his monthly expenses, freeing him from financial worries. His story demonstrates that compounding isn't just for the wealthy, it's a tool anyone can use to build financial security over time. Most brokers offer a feature called a dividend reinvestment plan DRIP, which automatically reinvests your dividends into the same stock without charging a commission. Setting up a DRIP is a straightforward way to ensure that your dividends are consistently reinvested, allowing compounding to work its magic without you needing to lift a finger. With a DRIP, your dividends go straight into buying additional shares, even if those shares are fractional. This automation keeps your investment growth steady and disciplined, reducing the temptation to spend your dividends. If your broker doesn't offer a DRIP, you can manually reinvest dividends by buying additional shares. While this requires a bit more effort, it allows you the flexibility to reinvest in different stocks if you're looking to adjust your portfolio's balance. The key is consistency. Whether you use a DRIP or reinvest manually, the goal is to reinvest dividends as frequently as possible to maximize compounding. To see the true power of reinvested dividends, let's consider a simple hypothetical example. Suppose you invest $10,000 in a stock with a 4% annual dividend yield and a modest 3% annual growth rate in the stock price. If you withdraw the dividends instead of reinvesting, your investment would grow to approximately $22,000 over 20 years. However, if you reinvest those dividends, the power of compounding would bring your investment to nearly $36,000 over the same period. That's the difference reinvestment can make, without you needing to invest additional money. This example underscores how even small dividend payments, when reinvested, can create substantial long-term gains. Compounding transforms each dollar earned from dividends into a building block of future wealth, creating a cycle where your money works for you, rather than the other way around. While reinvesting dividends is powerful, you can enhance your compounding results with a few additional strategies. 1. Start early. Compounding rewards patience, so the earlier you start, the greater the potential impact. Even small contributions made consistently over time can grow into a significant sum. 2. Focus on dividend growth stocks. Companies with a history of increasing their dividends regularly can accelerate your compounding. As dividends grow, the amount you reinvest also grows, which in turn boosts the number of shares you own. 3. Avoid high-yield traps. While high-yield stocks can be tempting, they're not always the best for compounding. Companies with excessively high yields often have unsustainable payout ratios, which can lead to dividend cuts. Instead, look for companies with moderate yields and consistent dividend growth, as they're more likely to support steady compounding. 4. Review your portfolio periodically. Compounding is a long-term strategy, but it's still essential to review your portfolio periodically to ensure that your stocks remain strong. If a company faces financial troubles or cuts its dividend, consider reinvesting in more stable options to keep compounding on track. Beyond the financial benefits, reinvesting dividends can have a powerful psychological impact. Watching your portfolio grow without needing constant contributions builds confidence and reinforces positive investing habits. You begin to see your dividends not as extra income to spend, but as the seeds of future wealth. This mindset shift encourages patience and long-term thinking, two qualities that are invaluable to successful investing. Dividend reinvestment is the perfect example of how small, consistent actions can lead to massive results over time. As you continue to reinvest dividends, you're creating a self-sustaining engine for wealth generation, one that will pay you back many times over in the years to come. In the next chapter, we'll discuss how to stay resilient in the face of market fluctuations. Just as important as growing your portfolio is protecting it during challenging times, and we'll cover strategies for navigating these moments while keeping your focus on long-term financial goals. Chapter 6. Adapting and Adjusting. Staying resilient through market fluctuations. Market fluctuations are inevitable, and even the most carefully crafted dividend portfolios will face ups and downs. The key to long-term dividend investing success isn't avoiding these fluctuations but learning to adapt and stay resilient. In this chapter, we'll cover the mindset, strategies, and tools needed to navigate market volatility while keeping your dividend income secure and your financial goals intact. For many investors, market downturns trigger fear and doubt. Watching your portfolio's value decline can be unsettling, but resilience in the face of adversity is what separates successful investors from the rest. When you're invested in dividend stocks, downturns can even present unique opportunities for growth. Maintaining a steady focus on long-term goals rather than short-term market movements is essential. Dividend investing is a strategy built for resilience, and this chapter explores how to leverage that strength. The first step in staying resilient during market fluctuations is developing a long-term mindset. Dividend investing is not about quick gains, it's about creating a stable income stream that grows over time. Many companies that prioritize dividend payments are well established and financially stable, and their long-term commitment to shareholders often means they continue to pay dividends even during economic downturns. Take the example of Veronica, a dividend investor who held onto her stocks during the 2008 financial crisis. While many investors sold their stocks out of fear, Veronica saw the downturn as a chance to buy more shares at lower prices. Her dividend payments remained steady, and by reinvesting those dividends during the market low, she acquired more shares and grew her portfolio significantly when the market eventually recovered. Veronica's experience is a reminder that with a long-term mindset, downturns can become opportunities to strengthen your portfolio. Market dips can cause emotional reactions, often leading investors to make impulsive decisions. Avoiding panic during these times is crucial. Selling dividend stocks in a downturn locks in losses, reducing your ability to benefit when the market recovers. Instead of reacting to daily market movements, focus on your investment strategy and the quality of the companies you hold. One way to remain steady is by reminding yourself of why you chose each stock in your portfolio. If you've selected companies with strong financials, consistent dividend histories, and reliable business models, you're likely holding stocks that are built to weather economic storms. Staying grounded in your research can help you stay calm and avoid making decisions based on fear. While dividend stocks tend to be stable, not all companies can maintain their dividend payments during extended downturns. Monitoring payout ratios and other financial indicators can give you a sense of a company's ability to continue paying dividends. A sudden increase in payout ratio, especially if it surpasses 70 to 80%, may indicate that a company is using a high percentage of its earnings to pay dividends. This could signal financial stress, and in such cases it may be wise to reassess your holdings. Another red flag to watch for is a dividend cut. Although companies often strive to maintain dividend payments, cuts can happen, especially during severe economic downturns. If a company cuts its dividend, it may be worth evaluating whether it still fits within your portfolio goals. Sometimes, reallocating to a more stable dividend stock can help you maintain the resilience of your income stream. Dividend investing can provide a reliable income stream, but it's essential to have an emergency fund to avoid needing to sell stocks during a market dip. An emergency fund gives you a financial buffer, allowing you to ride out downturns without liquidating investments. Having 3 to 6 months of living expenses saved can help you stay calm and focused on your long-term plan, knowing you won't have to sell stocks if you encounter unexpected expenses. During market declines, reinvesting dividends becomes particularly powerful. When stock prices fall, your reinvested dividends buy more shares, allowing you to accumulate assets at a discount. Over time, this can lead to more substantial gains when the market recovers, as you'll own more shares generating dividends. Embracing the opportunity to reinvest in downturns can enhance the compounding effect discussed in the previous chapter, accelerating your portfolio's growth. If you're investing new money during volatile times, consider dollar cost averaging. This strategy involves investing a fixed amount at regular intervals, regardless of market conditions. By purchasing shares consistently, you buy more shares when prices are low and fewer when they're high, reducing the impact of short-term price fluctuations on your portfolio. Dollar cost averaging is a steady, disciplined approach that can help keep you on track, particularly when emotions might otherwise influence your decisions. Adapting to market conditions doesn't mean abandoning your strategy, but it does mean remaining flexible and open to adjustments. Sometimes certain sectors might face prolonged challenges, and reallocating some assets can help you maintain income stability. For example, if the energy sector experiences a long-term downturn due to economic changes, you might consider reallocating some of those investments to sectors like utilities or healthcare, which tend to be more resilient. Portfolio adjustments are about fine-tuning rather than overhauling. It's essential to maintain your core dividend strategy, keeping your focus on companies with reliable, sustainable dividends. Adjustments should support your long-term goals, not respond to short-term market changes. Staying resilient during market fluctuations is easier when you remember your why. Your reasons for dividend investing, whether they're to achieve financial freedom, supplement your income, or build a legacy for your family, can serve as a powerful anchor during challenging times. Reflecting on your goals reminds you that downturns are temporary, and that your investments are a means to secure a future of financial stability and peace of mind. Navigating market fluctuations with resilience isn't just about protecting your portfolio, it's about embracing the ups and downs as part of the journey. By staying calm, sticking to your strategy, and adapting where necessary, you position yourself to not only weather downturns but emerge stronger on the other side. In the next chapter, we'll dive into common pitfalls in dividend investing and how to avoid them, ensuring you're equipped to make informed, strategic choices every step of the way. Chapter 7. Avoiding pitfalls. Common mistakes in dividend investing. Dividend investing, while reliable and rewarding, is not without its potential pitfalls. Avoiding common mistakes can help you protect your income and sustain the long-term growth of your portfolio. In this chapter, we'll cover the most frequent errors dividend investors make and provide strategies to sidestep them, ensuring that your path to financial stability remains smooth and successful. Every investor wants their portfolio to perform well, but the fear of missing out, FOMO, impatience, or lack of knowledge can sometimes lead to poor decisions. Understanding these pitfalls and knowing how to avoid them can help you make smarter choices that build, rather than jeopardize your wealth. Pitfall 1. Chasing high yields. One of the most tempting mistakes in dividend investing is chasing high yields. While it might seem logical to go after stocks with the highest dividend payouts, these stocks often carry hidden risks. A high yield can sometimes indicate a struggling company, one that's increasing its payout to attract investors despite underlying financial issues. These companies may face a dividend cut if they can't sustain the payout, which can impact your income and the stock's price. To avoid this pitfall, focus on companies with moderate yields, typically between 2% and 6%, and a strong history of stable or growing dividends. High-quality dividend stocks may not offer sky-high yields, but they provide more dependable income over time. Look for companies with a sustainable payout ratio, ideally below 60 to 70%, and a history of consistent earnings growth. These metrics offer a better foundation for reliable income than yield alone. Pitfall 2. Failing to diversify. Diversification is a cornerstone of successful dividend investing, but many investors overlook it, concentrating their portfolio in one sector or a few high-yield stocks. This lack of diversification can leave you vulnerable if those sectors experience downturns or if a company cuts its dividend. For example, if you invest solely in energy stocks, a drop in oil prices could drastically reduce your income. The solution is to spread your investments across multiple sectors, including utilities, healthcare, consumer staples, technology, and telecommunications. This diversification helps balance risk and ensure that if one sector underperforms, other parts of your portfolio can offset the loss. Dividend-focused ETFs can also provide instant diversification if you prefer a more hands-off approach. Pitfall 3. Ignoring dividend growth. While yield is an important factor, dividend growth is equally vital for long-term wealth building. Dividend growth stocks are those that consistently increase their dividends, often annually. Focusing solely on current yield without considering a company's dividend growth potential can limit your future income. A 3% yield today, with consistent annual growth, can become far more valuable over time than a 6% yield that remains static. Consider companies with a track record of dividend growth, often known as dividend aristocrats. These companies have raised their dividends for years, some for decades, signaling financial strength and a commitment to shareholders. Prioritizing dividend growth allows you to take advantage of compounding as your income steadily increases year after year. Pitfall 4. Overlooking financial health. A company's financial health directly impacts its ability to pay and grow dividends. Ignoring critical financial indicators like cash flow, debt-to-equity ratio, and payout ratio can lead to investing in companies that struggle to maintain dividends during challenging times. Companies with high debt may prioritize debt repayment over dividends if financial strain occurs, putting your income at risk. To avoid this mistake, research companies' balance sheet and cash flow statements. Look for companies with low to moderate debt levels, positive cash flow, and a sustainable payout ratio. These indicators provide insight into the company's stability and capacity to weather economic downturns without jeopardizing dividend payments. Pitfall 5. Being impatient with dividend growth. Dividend investing requires patience. Compounding takes time and dividends may initially feel small. However, these seemingly modest payouts can become significant as you reinvest and the stock's dividend grows. Impatience can lead some investors to abandon dividend stocks too soon, missing out on the exponential growth that comes from years of reinvesting and compounding. Remember that dividend investing is a long-term strategy, not a quick route to wealth. Focus on the long-term benefits of growing your income stream and building a portfolio that pays you consistently. Reinvesting dividends accelerates this growth, but it requires time and discipline. Staying committed to your strategy allows compounding to work its magic over the years. Pitfall 6. Ignoring taxes on dividends. Taxes can impact your returns, especially if you're investing in a taxable account. Depending on where you live, dividend income may be subject to different tax rates. Some investors overlook this, only to realize later that their after-tax returns aren't as high as expected. To address this, consider using tax-advantaged accounts, like IRAs or 401ks, for dividend stocks if possible. These accounts allow your dividends to grow tax-deferred or even tax-free with a Roth IRA, maximizing the impact of reinvested dividends. Understanding your tax obligations and planning accordingly can help you keep more of your investment returns. Pitfall 7. Not rebalancing your portfolio. Once your dividend portfolio is established, it's essential to rebalance periodically. Some stocks or sectors may outperform, causing your portfolio allocation to shift over time. This imbalance can increase your risk if one sector becomes overrepresented. Rebalancing involves adjusting your portfolio back to your original target allocation, either by selling overrepresented stocks or buying underrepresented ones. Regular rebalancing helps ensure that you maintain the level of diversification and risk you're comfortable with. For example, if tech stocks outperform and become a larger part of your portfolio, you might sell a portion of those stocks and reinvest in other sectors to maintain balance. Rebalancing keeps your portfolio aligned with your goals and reduces exposure to any one sector's volatility. Pitfall 8. Forgetting the big picture. Finally, one of the most significant mistakes dividend investors make is losing sight of their overarching goals. Dividend investing is a means to financial stability and independence, but it's easy to become focused on short-term fluctuations, individual stock performance, or the desire to beat the market. Remembering your why, whether it's financial freedom, supplemental income, or building a legacy for your family, keeps you focused and steady, especially during uncertain times. Staying true to your goals can guide your decisions and help you avoid distractions. Every investment choice should align with your overall objectives, supporting your vision of financial security and growth. Remembering the big picture allows you to weather setbacks and continue building a stable, income-generating portfolio. As you move forward, avoiding these common pitfalls can set you up for sustainable, reliable dividend income. With a steady approach, patience, and careful attention to financial health and diversification, you're better positioned to achieve the long-term financial freedom dividend investing can provide. In our final chapter, we'll bring everything together, focusing on achieving your ultimate goals with dividend investing and the financial freedom it can bring. Chapter 8. Financial freedom through dividend investing. Achieving your goals. You've come a long way in your dividend investing journey. From understanding the basics of dividends to building a diversified portfolio, reinvesting dividends, and avoiding common mistakes, you've assembled the tools needed to secure a future of financial stability and growth. This final chapter brings everything together, focusing on the ultimate goal of dividend investing, Achieving Financial Freedom. It's time to explore what financial freedom looks like and how you can realize it through a committed, disciplined approach. Dividend investing is not just a strategy, it's a lifestyle choice. It's about creating a stream of passive income that supports your financial goals, whether they include retirement, supplemental income, or the ability to pursue passions without financial constraints. With a solid dividend portfolio, your money works for you, providing a stable foundation that doesn't require constant monitoring or high-risk decisions. Financial freedom means different things to different people. For some, it's the ability to retire early and live comfortably without needing a paycheck. For others, it's about achieving peace of mind, knowing they can weather unexpected financial challenges. Defining what financial freedom means to you is essential to shape your investment goals and strategies. Take a moment to reflect on what financial freedom means to you. Are you hoping to retire early, supplement your income, or build a legacy for your family? Having a clear vision will guide your decision-making and keep you motivated, even during challenging times. Achieving financial freedom through dividend investing isn't an overnight process, but setting milestones can make the journey both rewarding and motivating. Start by establishing small, measurable goals. For instance, your first milestone might be to generate $100 per month in dividend income. As you reach each goal, you'll feel a sense of accomplishment, reinforcing your commitment to the long-term plan. Other milestones might include reaching a specific dividend yield in your portfolio, achieving a total portfolio value, or reinvesting a particular amount of dividends. Tracking these milestones gives you a roadmap, breaking down the journey into manageable steps that bring your ultimate goal within reach. As your dividend income grows, you'll reach a point where you can begin to enjoy the fruits of your investment. Crafting a sustainable withdrawal strategy allows you to draw income from your portfolio without jeopardizing future growth. A common rule is the 4% rule, which suggests withdrawing 4% of your portfolio's value annually to avoid depleting your investments. However, dividend investors have a unique advantage. By living on dividend income alone without selling shares, you preserve your portfolio's core, allowing it to continue growing and paying dividends indefinitely. For example, if your portfolio generates an annual 4% in dividends, you could live off this income while leaving your principal investment intact. This approach not only supports financial independence but also builds a lasting legacy for future generations. One of the most profound benefits of dividend investing is the peace of mind it brings. With a reliable income stream, you're less dependent on market performance or economic fluctuations. You can approach retirement or other life goals without fear of outliving your savings. Your investments are designed to work for you, offering both income and stability. Consider Laura, a long-time dividend investor. She spent years building a portfolio that eventually provided enough income to cover her living expenses. When she faced unexpected medical expenses, her dividends helped cover the costs without forcing her to sell shares or dip into savings. Laura's story illustrates how dividend investing offers a financial buffer, allowing you to handle life's uncertainties with confidence. As your portfolio grows, you may find that dividend investing offers the opportunity to build a legacy. The wealth you accumulate through dividends can provide financial security for future generations or support causes you care about. Dividend stocks can be passed down, offering your heirs an income-generating asset that continues to grow. Alternatively, you could allocate some of your income to charitable giving, supporting the values and organizations that matter most to you. Dividend investing isn't just about wealth, it's about creating a positive impact. Whether you choose to leave a legacy for your family, your community, or a cause, dividend investing empowers you to make a difference long after you're gone. Reaching financial freedom requires patience, discipline, and a steadfast commitment to your vision. Dividend investing is a journey that unfolds over years, even decades. Along the way, you'll face challenges, market fluctuations, and tempting shortcuts. Staying true to your goals and remembering why you started will help you maintain focus and resilience. To stay motivated, revisit your vision regularly, reflect on how each milestone brings you closer to your goal, and celebrate your achievements along the way. Financial freedom is a journey, but each step forward strengthens your financial security and brings you closer to the life you envision. Dividend investing can provide more than financial freedom, it can offer a life of choice. When your income isn't tied to the hours you work, you gain the freedom to spend your time as you wish. You can travel, pursue hobbies, volunteer, or simply enjoy time with loved ones. The financial stability that dividends offer allows you to design a life that aligns with your values, dreams, and passions. As you continue your dividend investing journey, remember that every investment, every reinvested dividend, and every milestone reached brings you closer to that life of freedom. This book has provided you with the knowledge, tools, and strategies to achieve financial independence. Now, it's up to you to put these principles into action, one step at a time. Let this be the beginning of a journey filled with purpose, prosperity, and peace. You now hold the blueprint for building a future defined by stability and growth. Embrace it, stay committed, and let dividend investing carry you toward a life of financial freedom and fulfillment. Final words. As you step forward from here, remember that dividend investing is more than a strategy, it's a pathway to the life you envision. Each investment, each reinvested dividend, and each disciplined choice brings you closer to a future defined by freedom, stability, and purpose. Financial independence isn't just a distant goal, it's a journey you're on right now, one that builds confidence, resilience, and peace of mind with every step. The blueprint for your success is in your hands. Trust the process, stay committed to your vision, and let your portfolio grow as a reflection of your aspirations. With patience, discipline, and the knowledge you've gained, you're crafting a legacy that will last beyond you, offering security and impact for years to come. Here's to a life of financial freedom, empowerment, and the fulfillment of dreams. Let this be the beginning of your journey to wealth, independence, and peace. Keep investing in your future, and let your dividends carry you there. Take care and be well.